Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, inflation is still running hot, and you can thank house prices for that. And do gambling ads belong on TV during live sports events? Plus, getting to net zero could be costly if Canada makes the wrong choices. That's all ahead. First, though, for the week that was in business, it's time for the briefs. Inflation in Canada ticked slightly higher in April, rising 4.4%, reversing a cooling trend with the first increase since last June. The gains were driven in part by gasoline, but also by rent and mortgage costs, which have been rising with higher interest rates, though those higher rates are designed to cool inflation. Meanwhile, the Bank of Canada warned that higher mortgages will hit even more households in the next 2 years. In its annual financial system review, the bank noted that about 1/3 of mortgages have repriced already, but as the remaining reset at higher rates, it will create strain on more households as their costs rise 20 to 40%. The bank also said, though, that even households dealing with higher debt now are, for the most part, managing. New data from the Canadian Real Estate Association underlined the hot housing market, with average selling prices up in April to $716,000 nationally. It's the fourth increase in a row. Most major markets are still down from the post-pandemic peaks, but have rebounded in recent months from what may have turned out to be a brief housing market correction.
The supply-demand issue we have in Canada didn't go anywhere. It was just sort of on pause. A lot of people waiting on the sidelines because of not just rates, but uncertainty. We've got some certainty around prices now. We've got some certainty around interest rates, and all those people are still there, but the listings still are not.
Average rents in Canada are now almost 10% higher than they were in 2022, with the national average monthly rent for a one-bedroom rising just above $2,000. In Toronto, a one-bedroom goes for about $2,500, while in Vancouver, that same unit rents for more than $2,700. European auto firm Stellantis says it will stop building a $5 billion EV battery plant in Windsor, Ontario, if the federal government doesn't follow through on certain promises. It's understood Stellantis is looking for some additional financial support. The federal government has expressed confidence that it will reach an agreement that keeps the plans in place, though it is asking the province of Ontario to kick in more subsidy. General Motors is recalling 42,000 SUVs in Canada because of a faulty airbag inflator that could explode if deployed in an accident. The recalls come as part of a U.S. Safety Board recall request that could ultimately affect 67 million airbag inflators installed over an 18-year period in a dozen different automakers' vehicles. And those are your business briefs. Inflation didn't cool the way some expected last month, but is it enough for our central bank to continue to wait and see, or will rates have to rise again? Benjamin Tal is Deputy Chief Economist at CIBC Capital Markets. Ben, thanks for being with us.
It's a pleasure. Thank you.
So let's start with that. This was a small uptick, but there was expected to be a decline. And some of the reasons for that inflationary pressure, I guess, have people wondering if rate hikes are working. I want to start with whether you think this will change the bank's view that they should still wait and see whether previous hikes will actually lower inflation.
Yes, the difference between a negative and a positive, and the positive won there, and the market is now freaking out. The Bank of Canada is not tweeting about the possibility of raising again in July. This is serious. Until now, we were under the impression that the Bank of Canada is done, but now everything is not working according to plan. The trajectory is different. So I think that the risk of the Bank of Canada raising again in July is real. And this will be, in my opinion, the beginning of overshooting. Let me remind you that almost every economic recession over the past 5 decades was helped, if not caused, by a monetary policy error in which central bankers raised interest rates way too much. And I fear that those numbers will lead to this kind of an error.
So that's the bad news, right? That we might have been able to avoid a recession, but if the bank keeps moving, they could actually cause a bad recession, or at least a deeper recession. But meanwhile, the pain that was showing up in the inflation data is higher rents and higher mortgages. Every time the bank moves to fight inflation, they make those things worse. So it's a bit of a catch-22, isn't it? A vicious circle?
Bingo, that's exactly the point, because the Bank of Canada is raising interest rates to fight inflation, and interest rates rising means that you have a situation in which you are paying more on your mortgages, and that's raising inflation. So it's like putting a humidifier and a dehumidifier in the same room and let them go at each other. This is the situation, and therefore you have to look at inflation minus interest payments in order to get where we are, and it's much lower than the official numbers. I think you are absolutely right. We have to look at what rising, what's not rising, and what to make sure that we measure it correctly.
So one thing I know that everybody will watch closely is labor market weakness. Will eventually, as we start to see these rates work their way through the economy, businesses slow down, maybe spending slow down, and then layoffs start to happen in a perverse way. We know the central bank kind of wants to see that. That's the weakness that would slow things down. Do you expect that to happen? The labor market's still really tight.
Yes, the Bank of Canada will never admit it, but they would like to see the unemployment rate actually rising. Mm-hmm. That's what they want to see. The market is too tight, wages are rising, and eventually it will happen. The question is when. And we are starting to see slowly the market normalizing. If you look at the number of vacancies relative to unemployment, it's starting to go back to where it was before the pandemic. The famous Phillips curves, the relationship between wages and the unemployment rate, is almost back to normal. So the market is starting to stabilize, but it takes too long, and the market cannot wait. And therefore, there is a risk that the Bank of Canada will raise again. Remember, this Bank of Canada will take a recession over inflation rising any day. And that's something that we have to take into account when it comes to measuring the effectiveness of monetary policy.
Only a few seconds here, Ben, but would you say, therefore, that all of this adds up to enough complexity that we might be at higher risk of a recession than we were a few weeks ago?
The short answer is absolutely yes, because I think that the Bank of Canada is much closer to raising again. And when you raise again, you're basically going to slow down the economy. Until now, we were talking about a wannabe recession. Now we are talking about a more significant recession, a real recession.
So good to have you always, Ben. Appreciate it.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist, CIBC Capital Markets. Coming up, one high-profile group wants to put a lid on ads for sports gambling in Canada as growth in gambling starts to explode. Stay with us.